Hi there, welcome to Big Grain TV. I'm Kevin McNew. It's Friday, February 26th. We had a down day in grains. Let's take a look at the Grain Edge trading platform and see where we closed. In Chicago, corn was off 1 cent a bushel, beans off 2, and wheat in Chicago off 1 3/4. Grains did manage to pare the losses that they were incurring early in the day. Today is the last day to get out of long positions in the March contract, so first notice day on Monday. So we did see some heavy selling early on in the trade session. By the last 30 minutes or so of trade, we did bounce off the lows, so that was somewhat encouraging. Let's take a look at the USDA Ag Outlook Forum again. Yesterday we saw the numbers that came out in terms of acreage expectations for 2016, where USDA painted a bleak picture for corn with them expecting 2 million more acres of corn, up to 90 million acres in 2016. Let's take a look at what USDA said today in regards to ending stocks, and this is their projections based on supply and demand numbers that they're coming up with for 2016 and what they are looking for in terms of carryout in the 2016 crop year. What you can see here is nothing that looks terribly bullish. Let's take a look first at corn, where USDA sees just a hair below 2,000 million bushels or 2 billion bushels of carryout. That is up from the current projection for old crop carryout of 1.8 billion bushels. In beans, they see better demand in the coming year, better crush, better exports. Even with higher production in next year's crop, they're still looking for a slight drop in carryout, but at 400 million bushel plus, that is still a very large carryout when you consider what's going on in South America. In wheat, even with the 3 million acre drop, they don't see much of a turnaround in terms of exports, and so they're looking for carryout to nearly get up to that 1 billion bushel mark. I suppose the one silver lining that could be coming down the pipe in terms of wheat is we are seeing some problems in global production, especially in the southern hemisphere, and we may see some better trade results. Right now, we're certainly not seeing them with the strong dollar and competitiveness or the lack of competitiveness of U.S. wheat in the global marketplace. But if Ukraine's crop is as bad as people are saying, we know India is having problems, there are some potential ramifications that could show their head in 6 months that may turn our export potential around, but right now it's certainly not the case. Let's take a look at May corn, because we're now getting into first notice day. So we're now looking at May corn, and where we've been trading the last few days is significantly down, and we're getting close to these lows that we established back in January. And we can see a lot of buying interest back in that January period around the range of 358 to 355, where that seemed to bring on some more buying interest. Not saying it's going to do that today or in the near future, but certainly we saw it today. We did trade down on May to 357.5. Right at the end of the session, we were able to rally in the last 2 hours of trade off of that low. Rally meaning about a 1 cent improvement or 1.5 cent improvement off of that low. So we're still at the low end of the range, but at least for the time being, we're above that support that is holding right now around 355, 358. Watch for that next week. If we get through that in the low side of the 350s, then I think that's problematic. I'm not so sure we're going to take that out. I think we might find some support here. We might find some short covering. There has been a pickup in export demand for U.S. corn, so that is somewhat supportive. But overall, this is not a market that's going to run away from us to the upside. So look for that 355 mark as support in the near term. We may bounce off of that and move potentially at least up to the 365 in the coming weeks ahead. That's all we got for the weekly edition of Grain TV. Join us next week and we'll see how the grain markets are faring. Silver right now is at historically low levels. Starting with the financial crisis of '08, silver prices made an epic run from $10 an ounce to $50 an ounce in just 3 years. Silver looks poised to make another run higher. Here's why. Today's headlines show wide-scale economic risk, central banks using negative interest rates to stimulate economic growth, and the continued explosion of government debt around the world. All these factors are creating a flight to safety in physical metals. On the fundamental side, high mining costs limits new silver supplies, while demand for silver continues to expand through rapid use in cell phones, plasma TVs, and batteries. All these factors suggest taking action at today's prices before silver reaches $25 an ounce. Our precious metals desk at GrainHedge can educate you about investing in physical metals. Their goal is to put the most amount of silver and gold in your hands at the least cost. To get started, contact Rodney at grainhedge.com or by phone at 877-472-4607.